I bet. Okay. Standard deviations. Now, there are a couple ways we can do it. You have your classic breaker block standard deviations, where you'll take it from the breaker here and you will take it down to here. I'll explain the levels coming in a little bit later, but you have one option here is your breaker, and we'll go over these live examples later on. But this is your first standard deviation that you can draw. Your next one is a mitigation block, preferably with SMT here, right? And it will act the same way as your breaker. You'll draw it from here to here. Preferably you have SMT here to kind of make this a little bit more powerful and to kind of make sure that you have this idea. Next, you have your consolidation here. Your consolidation, you're going to take just the consolidation high to the consolidation low, and you're going to use your projections here. It's going to be around the same, but you're going to be targeting different things when it comes to this. And then finally, you have your retracement Fibonacci, which is very similarly to the consolidation. It's going to work a little bit differently than these two here, and these two are going to work more similarly. So we'll go over the breaker block and the mitigation blocks first. And generally, with the mitigation blocks and the breaker blocks, there is most of the time there's going to be a pool of liquidity lining up in between the 2 to 2.5 here, a liquidity pool or a PD array. Now, this is the area where price is most often going to reject here. Doesn't have to be liquidity here, but most times when you draw this from the breaker, you're going to see that it's here where price comes down, has a little retracement before either finishing its model by taking the sell side down here, or coming back up and coming down to finish it off at the 4 standard deviation, which is your next point of rejection, the 4 to the 4.5. These are your 2 points of rejection here. Now, can price continue to go even lower once we hit the 4 to 4.5? Yes, we can. What is our standard deviations for that is that most likely you're going to get another breaker here, and you're going to get another continuation breaker off of this, and you'll just continue your deviations like so. It's getting a little whatever. Let me see if I can move all this here. There we go. So this is basically how it will look here. And what do we expect once price comes into the 2 to 2.5? Well, we want to see how far price can retrace up to here. And the idea is that price can retrace back up to equilibrium, coming into a premium before coming down, preferably at the 2 to 2.5. You want to see it come up to equilibrium, not past, and stay below equilibrium here. And once you hit that 4th standard deviation, now it's okay to assume that price would want to come back up into equilibrium, which would be all the way up here before continuing lower and coming into a premium. Once again, this does not have to happen. You do not have to see price come up into equilibrium. This is just as high as you can get. So if you are doing your standard deviations, and let's say you're still short biased here, price has already came into this 4 standard deviation. However, you believe the drawn liquidity is down here, right? Instead of getting in right here, once you know that we've hit that 4th standard deviation, you want to see how far price can retrace up. Most times, price, once it hits the 4th standard deviation, if it's not in a big hurry to get down to this liquidity pool, will come up towards equilibrium here. And this is where you're either going to find whether or not we're going to do a continuation model and continue down to these lows. And it's inside this equilibrium area where you're going to see your second continuation breaker form here. And this is what you're going to take and draw your projections to continue lower down to your original drawn liquidity. Now, I'm not going to go over mitigation blocks, as it's basically the exact same thing as your breaker. It's just the lineups are a little bit different. So do we have any questions about those right now? Awesome. If we have no questions, I'm going to move on to the next one, which would be consolidation and your retracements here. So when it comes to consolidation, it's going to work a little bit differently. You're going to see a consolidation phase right here, usually resulting in an AMD. Doesn't have to, can result in just a continuation down. However, when you are looking at this right here, your first profit target will always be the 0.5 here, unless there is another liquidity pool somewhere here, because most of the time price is going to be big enough in this consolidation. Let's say the consolidation went up to here. right? That 0.5 will be a good first or final profit here. If you are bullish biased, but you do see a setup, something like this comes up like this here, right? Your first take profit will always be that 0.5 area right here. Second take profit, and you just use these standard deviations here as every single take profit. And if price does choose to go down here as well, your 2 to 2.5 will be your rejection zone as well right here. However, this specific Fibonacci sequence, or the way you'll draw these standard deviations, will just be, and how you'll use these standard deviations will be, you'll be taking profits at everything here: 0.5, 1, 1.5, and then eventually the 2 to 2.5. But most times you're assuming price might not reach here, especially if there's no real liquidity pool. For example, if we just had a straight shot up here, right? Maybe we had fair value gaps or somewhere here, maybe you don't even have to. However, price can and will come down to the 0.5 standard deviation level. This is your low hanging fruit. 9 out of 10 times this will be hit before rejecting up. So this is why this will be your first take profit point if you are trading something like this. Now, the exact same thing works for your retracement here, retracement zone right here. Your first retracement, this is basically, let's say this is what price did. It's just coming up here, right? It's coming up, it comes down into a fair value gap right here. What do? Your swing high, or your short-term high here, down to your short-term low that we made inside of this fair value gap. You're going to draw your projections here. Once again, first take profit on the 0.5, next take profit on the 1, and then afterwards you'll most likely hold out for the 2 to 2.5, and this is going to be your rejection zone right here. Now, this also heavily depends on where you are currently in the market. For example, if you took this fair value gap right here, that's, let's say, in discount, for example, chances are, if your bias is correct, you're going to get up to the 2 to 2.5 most of the times. Now, if you're buying more in a premium here, chances are I'm going to move this here. You want to take your profits here at that 0.5 or that 1 level, just to make sure you guys are able to secure profits, because price is most likely not going to come up into the 2. Do we have any questions about that? Okay, cool. Really quickly, for anyone who wants to screenshot, this is my settings for the Fibonacci, for the breaker block and the mitigation blocks. Feel free to take a picture of this. All right, and this will be the settings for this one here, which would be your retracement and your consolidation Fibonacci's levels here. Give you a second to take a picture there. Once again, do we have any questions about how to draw these out? Any questions about where to take profits, what to look for? Awesome, then let's move on to some live examples. So let's use our first live example of, we can use a fair value. We can use a retracement real quick, and we can do a breaker block as well. But let's say right here, we have our first retracement here. Once again, it is in discount of this range here. So let's just take this range right here, right? So this is in discount. This is equilibrium. Anything above here is premium. Anything below here is discounted, right? So we can take our Fibonacci sequence right here. We can do our projections right here, and we can take it out up to the 2 to 2.5 area here. And here's where you can see we had a little bit of a rejection here, right? Your first take profit would probably be here at the 1. Then you can probably hold out for the 2 to 2.5 if you're not confident in price reaching up here, or if you're assuming potential SMT is going to take place here as well. Now we can move on to the next retracement level here, which is still in a discount right here, just barely, right? You can draw your standard deviation levels from here again. And you can see, you can have your first take profit at the 1 right there. You can get that right to the tick before price comes down and drops. Your next take profit could be the 1.5 here, assuming this is not going to be hit, but we do have a liquidity pool that lines up perfectly with this 2 to 2.5 zone here. So you can anticipate to hold out for here before you get that rejection. Now, if we were to take one that's in premium here, right, you're expecting price to only come up to the 0.5 and the 1 here. And this is exactly what we see here. You get that 0.5 right here before price comes down, and then you get that 1 before price comes down, not reaching this 1.5 area. It does sweep this liquidity, but this is just going off your general Fibonacci levels right here. And that's one way you can use to take your profits. Your second way would be to use your standard deviations here, which would be from the breaker block. Now, it depends where you... What the fuck happened? Hold on. My fault, guys. Here, right? Your 2 to 2.5 is up here. We can see price does come up here into the 1 to 1.5 here. And I should say this. Actually, I forgot to mention this before. If price does not come into the breaker block here, see how we have left this breaker block here untouched here. Price will go to the 1 to 1.5 here, reject the 1 to 1.5. Not saying it's going to reject and continue lower, but it's going to reject and come back down most of the time to give you an entry on the breaker block. Here we didn't get that, but here we did get that retracement back down here into a discount here before continuing up to the 2 to 2.5 here, which is this liquidity level here. We can see we perfectly get that liquidity level there in the 2 to 2.5, and now we're continuing down. Now, if we wanted to continue up, you would take your equilibrium from the bottom of this breaker here to the top right here, and you will do your equilibrium here, and you'll look for price to come down into equilibrium. This is as far as it can go if we want to continue going up here and continuing to this fourth standard deviation. However, if price wants to come below this equilibrium point right here and kind of come down and take this liquidity, most chances are we're not coming back up to the 4, and we'll have to look for another breaker block somewhere here. Does that make sense for now? Any questions? All right, cool. Now we'll kind of move on to, I guess, consolidate. We can look at consolidation here if we really wanted to. We can look at this level right here. See if we get this here. So your consolidation, right? What your projection is going to be. I think it'll be which high is higher? This high is higher. So you'll take your consolidation low, your lowest low of the consolidation leg right here, to your highest high of the consolidation leg right here. You're going to draw out your standard deviation projections here, right? And once again, price comes 0.5 and rejects that. And once again, that is your first take profit always if you're coming off a consolidation, right? Because let's say you entered off of this fair value gap right here, right? Just right there, your first take profit will be at here because there is a chance that price will not come down and take this liquidity here. You might see an SMT here, you might see something. So it's always good to take your first profit at that 0.5 standard deviation mark. And if you want, take a partial here and take your full take profit here if you want to, right? Now, if we were to do the same thing with your retracement right here, which we saw here, we retraced into your fair value gap. You do come a little bit lower here, but this is such a small range that I wouldn't put much to it. You can draw your same range from this to right here, and you can see we kind of reject that one area. But for the sake of it, I would just, unless you're kind of in like an actual buy model or like a continuation up with actual retracements in a trend, like something like this, we'll go over that in just a second one more time too. Right, you'll just draw it from the lowest low of the consolidation to the highest high right here, and you'll take your profits at 0.5. Same thing here. If you wanted to, here you can take your profits at 0.5 here if you wanted to consider this the start of your consolidation, or even this the start of your consolidation up here, right? This is your 0.5 first profit taking zone right here, always when you're coming out of a consolidation. Same thing we can see happen here, right? Your first take profit zone will always be that 0.5. As you can see, price has not come back up into the 1 until later here. So just keep that in mind when you are doing it off your consolidations. And once again, this is strictly for take profit purposes. This is not going to tell you where price is going to reverse, although I would still hold emphasis on the 2 to 2.5 zone to make price bounce. Now we'll go over another example here, right, where you have your breaker block here. Why is this a breaker block? This is your low, high, lower low, higher high. Don't worry about this right here. This is just your time distortion. This is internal of this range still. So this is your breaker block right here. Where do we reject off of? 2 to 2.5, right? Where do we come down to? Right? We come down below equilibrium here. Equilibrium, which is 50% of your Fibonacci. From range low to range high, we come below equilibrium here. See how we don't hold equilibrium here? So chances are we are not reaching that fourth standard deviation until we make another breaker that's going to allow us, or a mitigation block that is going to allow us to show our standard deviations to go higher here. So this is the exact zone we rejected. As you can see, there is no real liquidity here. Maybe really far back, there's potential liquidity, but you can just see off the breaker block, your 2 to 2.5 is your first rejection zone here. Now, once price comes down and breaks and stays below equilibrium here, and I would say even once price takes this out, your projections from here are going to be most likely invalid. Not saying they're completely invalid, but chances are you're going to you're going to draw new standard deviations from a new setup that forms here, and we'll go over that right now. In this case, you don't make your breaker until all the way up here. So for now, we can use our mitigation block. And what a mitigation block is basically a breaker, except we don't sweep that liquidity. So this would be your mitigation block level right here. And as you can see perfectly, again, from the 2 to 2.5 zone right here, we are rejecting that. No real liquidity up here. We are rejecting that. Now, I'm going to show you guys something else. Off of this breaker block, what did I say would happen off the breaker block? If we start to reject the 1 to 1.5 level and our drawn liquidity is still higher. When we come into the 1 to 1.5 level here and we reject, which just so happens to be the exact 2 to 2.5 level here, right? Not just a coincidence, but once you come into here, this is your little reversal zone, possible reversal zone. And when you line it up with your mitigation block, 2 to 2.5 here, right? You're able to know, okay, once price comes into the 1 to 1.5 here, you're going to get your retracement back into your breaker block. Boom, right? Here we go. Price rejects the 1 to 1.5 here, comes back into the breaker block here, and continues higher, right? And we can even look at our mitigation block's fourth standard deviation here, which doesn't quite get hit, but there you guys go. You guys can see that that's exactly where we went up to here, right? And you have another mitigation block here, and you guys can just continue to rinse and repeat this process, and you keep going, and you keep going, and you keep going. So do we have any questions about this at all? And if not, then I think we are good to wrap things up here. Once again, equilibrium here, price hit the 2 to 2.5 off of this mitigation block here. So we can expect price, right, to come down into equilibrium if it wanted to, but we don't want it to see it hang by equilibrium for long, range high to range low. We see it come right into equilibrium here, just to come into that breaker block. Look at the bodies respecting that perfectly, and then continuing higher. Right, once again, if we wanted to draw our projections from here, you can see that we hit that 0.5, which is your low hanging fruit, which you're going to want to target always. So do we have any questions about any of the fib projections? Do you guys want me to show you guys my settings one more time? If not, then I think we're done here, unless Arlie wants me to say anything more that I've missed. I don't think there's anything much to it. And once again, this is all fractal here. So even if we were to go to a different time frame, if we wanted to, here everything here is still fractal. So
Yep.
yes,
So one
everything
question I
here is
actually
still
had
fractal.
was,
Mhm.
because I was taught to mark out my deviations on the 1 minute. Can you show me an example how you would just mark it out on a higher time frame? I know you said it's fractal, but I just want to see.
Yeah, so it'll be the exact same way. If we're looking at, for example, I'll go over a breaker block and a mitigation block here. We'll come over into this breaker block right here. Why is this a breaker block here, guys? Well, you have your high, lower low, higher high. Yeah, that should be like right here, technically. Yeah. High, lower low, higher high. Oh, sorry. High, low, higher high, lower low here. This is your breaker block here. You draw your standard deviations here, right? What do we see here? 2 to 2.5. You have your rejection here, right? Where do we go from this 2 to 2.5 to up here, right? How far can we go up? Oh, we can go back up to equilibrium, come right back up to equilibrium here, start to reject equilibrium. We make our next internal breaker block right here. I don't know how much you would trust this. This is internal, but it is also a continuation breaker. So you can continue to draw your standard deviations down from here. I would not put that much emphasis on this though. I would put more emphasis probably on this right here, this one right here. And you can see here, we kind of blow straight past that 2.5, but you can see here, we did reject this 4 to 4.5 here. Once again, I would not put too much emphasis on this right here, right? I would probably come and put a little bit more emphasis on this mitigation block here. But yeah, does that make sense for the standard deviations there, Arlie? And if you
Yeah,
do want to, you
totally.
can do your range low here to your retracement high here. Do your projections as well. You can see we've reject right off that 1.5 level right there. Okay, and this could also be another internal breaker block to go lower. And I can probably show one more that goes higher here. Yeah, it's not really a good one, but you do have your current breaker that has formed right here, right? And it's assuming, and it's telling us that price is going to go higher up to the 2 to 2.5 range here, which just so happens to align with this liquidity pool right here. Now, did we get an entry into this breaker here? No. Does that mean potentially, since we are rejecting this 1 to 1.5 zone right here, we could get a retracement back down into the breaker for an entry? Possibly, but it all depends on what we want to do here. And I think we have a little bit higher to go with these relative equal highs. But does that make sense? Do we have any questions or anything like that? If not, then we're gonna close up this session here. That'll be it.
I think we're good. Yeah, I think we're good. Beautifully explained. I think we'll get another session going on later on with Plethora covering time-based deviations. If not, we could schedule it for next time. Definitely, if you guys have any more questions, feel free to ask even after the sessions. Um, what else could we cover? But no, beautifully explained. I think that's it.